All right, so we are recording this now. Okay, so the reason so we spent a lot of time on YTM, which as you can see here, the reinvestment assumption is not understood by people. Even by Graham has actually not made a qualifying remark here. Actually, when he said yield obtainable, the correct way to write this would have been to say the yield obtainable with a little asterisk, and then say, strictly speaking, only if the YTM, if all the interim coupons can be reinvested at the YTM. This is the YTM that he has looked up from the bond pricing, bond yield pages. And then he's saying this is obtainable, but it's only obtainable if it's if all the coupons can be reinvested at this rate. This is the sense of yesterday's session, the previous session. So we spent a lot of time on this simple point, but it's important we understand these things because they are basic concepts of finance. Okay, so and this is important because this is important because of this. There is a very clear implicit assumption when we discuss debt market yields, which are YTMs, that if you hold the bond to maturity, you will realize that YTM, which is not true unless this assumption number 3 holds. So it's very important to be aware of that. I'll show you an article also which disputes that this is an assumption, but actually they don't understand this particular point I'm making here. So anyway, so the YTM definition we went through yesterday, on the previous day. Okay, now let's look at a few other things. Now I've given you a bunch of links here. These are the Treasury yield curve rates. We clicked on most of these. You can have a look at this. So there are some long-term charts. So these are very important rates. Okay, so you've got to get into the habit of tracking when you track global markets. If you look at the discussions, I've told you to track all the global markets and listen to Bloomberg TV, the market commentary, etc. If you do that, okay, so this is not very well displayed. There you are. This is the yield curve. Okay, so this is the normal way of displaying what is called the yield curve here. Okay, because this is just nothing but, I mean, you've already seen all this stuff before. Okay, you can do the same thing with, say, what you're more familiar with, maybe HDFC Bank fixed deposit rates. You put the maturities on the bottom here. Okay, put the maturities here, and then you put the interest rates here. How much am I getting for 5 years? How much for 10 years? So it's just a different interest rate, and sometimes we plot them like this by showing it like what's the current rate, which is the blue one, and what was the rate 1 month ago, which is the green one. Maybe you can make it a little bigger here. My God, hard to get rid of these guys. Okay, that's good. That's good. Okay, you can still see it here now, right? So the blue one, this is a very normal way of showing yield curves, where you show what in one chart you can show basically what it was, basically 3 different snapshots in one chart. All right, what it was, what it is today, and what it was 1 month ago and 6 months ago. And so this is how it's normally shown. So you can see this is a normal yield curve. Or this is a normal yield curve, and if it's the other way around, the short rates are higher and the longer rates are lower, then we say it's an inverted yield curve. So this is a normal yield curve. So this you can see here. So this is how you plot that. So this is one way of looking at this. I wanted to show you this. Okay, so this is called a yield curve. It's also called where is the yield curve given? Let me just write it here. You should know these terms. These are very important. Okay. Term structure of interest rates. Since we're discussing YTMs, we're going to have a little bit of a discussion on bond markets. Very important fundamentals of bond markets, which you must understand. And so we're going to use this part in the book as an excuse to learn about some of the fundamentals, make sure those are clear. This is called the term structure of interest rates. Okay. Anytime you have a chart like this, you can call it a term structure. You may call it a term structure. In this case, it's the term structure of United States Treasury government, Treasury securities, government debt securities. And then anytime it's a term structure, why is it a term structure? Because the axis here has all the different maturities. These are the terms, right? So what I might ask is, what is the term of your FD? What I mean by that is, well, how long, I mean, when does your FD mature? So this kind of a chart, whenever you have the maturities or time periods on this axis and the rates or the prices on this axis, then you can call it a term structure. And in this case, we are plotting interest rates, so we call it a term structure of interest rates. So I would not have the time to teach you options, but in options, one of the important things we do is we have a term structure of implied volatilities, which are essentially a proxy for option prices. So those would also be plotted this way. So you would have the maturities on this side. And so what would be the percentage implied volatility for a 6-month option, or or a 12-year option, or an 18-year option, etc. Normally, you don't have options for that very long, for such long maturity, for the shorter maturity. So let's just look at these as months in the case of options. So same thing. That would be called a term structure of implied volatilities. So the term structure is the more important term, expression, term structure. And what are you plotting? That becomes term structure of X. X here in this case is interest rates, because you're plotting interest rates. I'll try to show you a IVOL term structure so that you just have a sense of this, because this term, you have to understand this expression, term structure. You can have term structure of all kinds of let me just see what we have here. Okay, we don't have this. Just give me a second, I'll just try. Okay, we'll do that later. Later on, I'll find something. But the point is to understand what is meant by the term structure of the expression term structure.
Sir, your voice is breaking in between.
Okay, 1 minute. I'll just try to understand. I'll just try to get this right. Okay. Let me just take this in here. Okay. Is this clearer now? Is it clearer now?
Sir, not clear. Same as earlier.
Breaking. Okay. How is it now? Is it better? It might be just.
Some words are good enough, but in between it is a problem.
Fine. I'll let me just see. I think I don't know. It doesn't seem to be related to anything that I'm doing. It might be just due to the variation in the connection quality. All right. I think that's the only thing that I can think of that.
So you can only hear part of the sentence that you're saying.
That's very strange. 1 minute. Is it better now? Is it better now? Okay, let me try it without the headphone. Let me just try it without the headphone. Is it better now? I mean, I'm just actually trying it in a different way. Is it better now?
Yes, sir.
Yes, sir. It's
Much
better.
Much better? Okay, fine. So we'll stick with this structure. Okay, so now fine. So if you have any problem further, still let me know. Okay. So, all right. So this is what I mean by term structure. So a little bit of a deviation, but you need to understand how this is a general expression, term structure. So as I said, anytime you have a chart which shows the maturities on this axis, on the x-axis, then and you show some prices or in percentage interest rates on the y-axis, That can be called a term structure. So this is a term structure of US Treasury securities, which are government debt securities, and what kind of yield is obtainable on them. Just focus on one of these lines at a time, the blue line, okay, which is the current rate. So you'll see the maturities on this. So we call it a term structure because the terms are on this axis. Okay, so what is the structure of interest rates across the terms? So that's why term structure. Now, general term, because you can also call it term structure of implied volatilities for options, which I won't have time to teach you, but you should learn yourself. Okay, and I will give you good books on options to study. So term structure of, we have term structure of implied volatilities, which you can see here. This one. No, one second. Where did I put that? Anyway, I'll put the link in later on. Yeah, this is the link, right? So Futures Mag. This is the, yeah, we have that already. So you can see the VIX term structure. VIX is an index of implied volatilities. We have it in India also because VIX is a trademark. So they have now something called an India VIX, which is options on Indian equity indices. And what is the average price of options on Indian equity indices? So this the VIX term structure, you can see the same thing. Term structure of volatilities, different months, 2 months, 4 months, 6 months, 8 months, etc. And what are the different prices? Here in this case is an index, so this is not in percentage terms, in terms of prices. So this we call a term structure of implied volatilities because the VIX is an index of implied volatilities. This will make sense to you later on when you study options. But the point is to understand that this is the implied volatility here. We can write this here. Term structure of implied volatility. We will write this as levels. So the expression term structure remains, but now we are not plotting interest rates, we are plotting implied volatility levels. Okay, so that's just a little departure. So I'm just going to close this now, and I've given you the link, right? So now, so you can plot some long-term charts, etc. Now, the other thing I wanted to just make sure you guys have time, take time to study, because you will have, let it be there like what it is. So please study these. This is a very important link. Let me just open this and show it to you. Okay, this is a treasurer's handbook. This is very important for people going for careers in corporate treasury, or even otherwise. There are very important, there's very important learning to be had from this. So please make sure you read all this stuff on your own. Obviously, I'm not going to have time. Normally, I do this in IFM, but I'm not going to have time to do this. So all this stuff, please, there's a lot of learning here. And this is done by and some of you might consider doing the ACT qualification. If you're looking for a career in corporate treasury, this is not a bad thing to do. So ACT is the Association of Corporate Treasurers. These are the guys who take care of all the financing needs and the risk management needs of corporations. These guys are called treasurers. So it's a very useful wiki-style book. Please read all this stuff for yourself. And one particular one that I want you to read is corporate credit ratings. Please make sure you read this stuff because CARE ratings normally comes to the campus for interviews. And we have been placing people pretty much every year, sometimes more than one. So go through this, understand what credit ratings are, and understand that like this kind of thing. So you don't have to memorize this, okay? You don't have to memorize this because it's too much and it's not worth it. But you should understand the broad structure, and you should have a link to this. You should know where your hyperlink to this thing is so that you can quickly pull up the chart if you want to have a specific discussion. These are the different companies, Moody's, S&P, and Fitch, the major credit rating agencies. And these are the credit ratings. So like India's credit rating is just about investment grade. Okay, so this, we say this becomes junk, non-investment grade. This is called junk bonds. You might have heard of this, like junk food. You have junk bonds. So India right now is somewhere here, okay, just above investment grade. So you don't have to, as I said, you don't have to memorize all this, but you should know how to quickly pull up this chart. And then you can talk about it. Okay, and so these are better. So this is the best quality rating. So if you have a company like Unilever or Procter & Gamble, their debt will be rated AAA because they're so cash rich, consumer product companies, and their ability to repay their debt is, is without question almost. So these are going to be AAA rated. So their interest rate that they pay will be less. okay, than what a lower graded corporation will pay. So this is how it works. Okay, so and as you go down the thing, these guys have to pay higher interest rates because these are very low rated companies, and there's a probability of default is very, very high. So if you have this kind of credit rating, then you will be paying a much higher interest rate. Okay, so understand that. So this is the basic understanding. So we are still continuing the discussion of interest rates, and in this, I'm going to use this opportunity to quickly educate you on something very important on the pricing of bonds. Okay, and so again, this will take a long time, but this is a very important thing to learn so that you are aware of this very fundamental element. Okay, pricing, uh, bond pricing. Okay. Again, we normally say bond pricing, but actually what we should say is this is how the market talks. Okay, the market is not going to say bond pricing. The market is not going to say debt security pricing because it's too much. But the correct expression is debt security, not bonds. Because why? I've told you this before. Anybody wants to tell me why? Why is bonds not the correct expression? Why is debt security the correct expression? I have mentioned this to you before. Has anybody picked up this point? It's not in your notes, but I mentioned it in the class. Anybody wants to tell me what it is?
So because debt involves bonds, debentures, and other securities as well.
So what are some of those other securities which might be different from bonds?
Debentures, other treasury bills.
That's right. So I'm looking for the answer that I'm looking for is treasury bills. So remember the difference. I think this might have written this I might have written down somewhere. That initial maturity. No, the initial spelling is wrong. Initial maturity. Uh, uh, one. Okay, so I have not written this anywhere. So let's write this. Okay, so that point is correct. That actually it is about treasury bills. So now the way we normally, so the reason why is it bonds and why, so the market will just say bond pricing, but actually the correct expression is debt security pricing because debt security includes, money market instruments. Let me write this a little bit also here. So since we are having this discussion, okay. Debt security includes money market. I think I have this discussion somewhere down below. Okay, let me just see. I have, as I have prepared notes. Money market versus bond market confusion. Let me write this here, and then I'll remember that. So we are these distinctions are very important. So while I'm discussing YTM and bond pricing, bond market pricing, this is very important to understand because, for instance, very recently HDFC Bank has done a big. I think they've priced about $1 billion worth of additional tier one bonds on the international markets. So let's try to understand how that would have happened. Okay, this is very recent. Actually, I think this is less than less than a fortnight old. Actually, this news. So so debt security includes money market instruments. So please understand the conceptual ideas here. Okay, money market instruments like T-bills and commercial paper. Okay, so please understand commercial paper is also a money market instrument. Okay, so what is the difference? Money market versus bond market confusion. So why I say that technically, although in the market they will always, in the industry they will always just say bond market, because it's a much shorter word than having to say debt security. But conceptually, at this point, you should be saying debt security because this is a more inclusive term, because it includes money market instruments like T-bills and commercial paper. Bonds, when you use the word bonds, you strictly speaking do not include money market instruments because you're only talking about money markets. Okay, so there is a basic difference between the basic split in debt capital markets. Okay, so these are debt capital markets. So let's look at this. I will just run through these ideas once again. Okay, so let's look at this. So this is our topic: money market versus bond market confusion, and the whole thing is coming under the discussion of YTM. And I'm going to use this to make sure you understand some basics of debt markets. So now let's look at. I'm just going to give you the basic understanding. Capital markets is equal to DCM plus ECM. Okay, and hybrid are included. Hybrids. What is an example of a hybrid security, which is neither debt nor equity? DCM stands for debt capital markets. ECM stands for, all of you are interested in investment banking. In India, you will see that investment banking there's a misperception about investment banking. And this is what really investment bank is all about. It's capital markets. It's the new issue business and capital markets mainly that investment banking is all about. But in India and to some extent international markets as well, also there is a confusion that M&A valuation related activity is investment banking. That's actually not correct. Okay, so when you do investment banking, that's related to capital markets. So capital markets are markets for capital securities. Okay, so we divide capital markets into DCM and ECM. So DCM is not Delhi cloth mills, but debt capital markets. Okay. And ECM is, what is ECM? Anybody?
Equity.
Correct.
Equity.
Yeah. So so it is equity capital markets. So this, you'll be familiar with these terms because in the industry people will just say DCM and ECM. Okay. So hybrids, what is an example now? We talked about different types of securities. Like if you go back to there you are in your standard balance sheet. Okay. Now here we have equity and debt. Now, can you name some kind of security? We discussed this during the Solomon versus A. Solomon and Company case. Give me an example of a security that is neither equity nor debt. Neither pure equity nor pure debt. Any example?
Mutual funds.
Mutual funds. No, mutual funds. That's right. Preference shares is the right answer. Okay, so preference shares is what I'm looking for. Hybrids, example, preference share. So when I say hybrid, okay, hybrids, example, preference shares. Okay, another type of hybrid which is listed in your Solomon discussion. There's a hyperlink there as well. You can search for this. COCO bonds. Okay, COCO is for contingent convertible bonds. Okay. Hybrids, example, preference shares and COCO bonds. These are examples of hybrid securities. Why are we calling them hybrid? Because they're neither equity nor debt. This pure equity should be pure risk-bearing capital, which is your common shares, or what we call in India, we call equity shares. Okay, so the other term is preference shares. So preference share is kind of like what we call a mezzanine capital. So it is kind of in the sandwich between two floors. In real estate, we use the term mezzanine to indicate a floor which is between two floors. So mezzanine capital is stuff like COCO bonds and preference shares, which are hybrid securities. Because they're neither pure equity nor pure debt. Okay, so we are understanding capital markets. So what are we understanding? Now we are going back. We were talking about YTM, which is really related to debt markets. But we are going. Somebody is not on mute. You need to check that. Yeah. There's a rustling sound. You need to check. Please check that you're on mute. Tapur is not on mute, I think. Yeah, so Tapur's sound was the problem. Okay. All right. Now, so we will understand what we're doing. These are very important basic concepts. I want to make sure you get them right because they're not very well explained in the textbooks. So your conceptual clarity, we need to work towards that on the foundational concepts. So we were discussing YTMs, yield to maturity, and so that's something that is that's a point, that topic that comes up when looking at debt markets. So let's look at capital markets and how debt market stands within capital markets, and to also clear up the money market versus bond market confusion. Right. So let's look at. So we are going back to study capital markets. So capital markets, capital markets should be onion market means market for onions. Smartphone market means market for smartphones. So capital markets should mean markets for capital or capital securities, where what you do is companies come and sell equity and debt and sometimes hybrid securities to raise capital. And so they raise capital, and in return they give you a little chit saying, okay, you are the holder of equity shares, or you are the holder of preference shares, or you are the holder of debt securities, okay, so on and so forth. So we are exchanging the securities, the capital securities, for capital, which is the cash infusion that the company gets. All right. So these are capital markets. So capital markets, we normally, although we have hybrid securities, we don't normally have them as a separate classification. So we only talk about capital markets as consisting of DCM and ECM. All right. So hybrids will be included in either DCM or ECM. In terms of the organization of the issue, like for instance, let's say if Credit Suisse has helped, in the case of the HDFC bond market issue that we talked about, which is just about a fortnight old, that's a pure debt market instrument, so there's no hybrid element there. But if HDFC had issued a hybrid preference shares, now whether that is to be managed by and it's being managed by Credit Suisse, okay, so whether it's being managed by the DCM or ECM is largely a matter of the investment bank's organization, how they decide to organize it, right? So then it's a matter of organization. It can be located in either of the two departments. So now so mainly we have to in an investment bank, which is this is the pure business, this is the classical business of investment banking. Okay, so remember that M&A valuation work is not investment banking. In India, people, when they say investment banking, that's what they mean. That's actually totally wrong. Okay? So that's not really the core business of investment banking. Is the capital markets origination business, which is when you sell new securities, when you get companies to issue. Like a bunch of people would have come from Deutsche Bank and from Credit Suisse or from Goldman Sachs, and they would have had discussions with the people at HDFC because they know that HDFC wants to raise money. So they would have said, okay, you can do this, you can do that, lots of discussions, and then they would have given the mandate to one of the investment bankers, or maybe a few of them. Okay, let's say, so they, for the sake of simplicity, they gave it to Credit Suisse. Credit Suisse is managing the issue. Okay, so this is how it works. So this whole business of IPO, that all that stuff you see every day happening in our equity markets, that's all investment banking. That's pure classical investment banking. So investment banking is not M&A. Okay, so please understand that. Because there's a mistake, there's a perception problem here. Okay, so capital markets. So investment banking is concerned with the primary capital markets business. Okay? So DCM and ECM, this is the organization of departments, and hybrids will be managed out of either of the departments. Okay. Now DCM is debt capital. This is equity capital. Now what are we talking about? Now let's focus on debt capital markets. Okay, I'm just giving you a broader perspective. Although we are concerned with YTM, which is really to do with debt capital markets, I don't really need to tell you about this. But I always like to give you a broader perspective so that you know where your particular topic is located in the broader picture. I think it's very important, actually, I think. So, right. Now, let's go back to our main focus, which is debt capital markets. I may just want to make just give me a second. Let me just load the alarm clock. All right. Okay. So what we talk about is debt capital markets. We're going to talk about debt capital markets. Now, so you see, first, capital markets are divided into DCM and ECM. Okay. Now we are going to talk about debt capital markets. Right? So we under this topic of money market versus bond market confusion. Now we're going to talk about this and so let me put this as let me put now I'm putting the exclamation mark here to explain. Okay. Why they would exclude the money market instruments? That we'll understand, because the classification of debt markets is into bond markets and money markets. So this is your little qualifier for this. I think maybe we should put it like this so that we know that this is like a footnote actually. Yeah, so this is like a footnote now because I'm using the star for a different reason, so I can't put the star as a footnote indicator. Okay, so this is your little clarification. So why do we want to say debt security into debt markets rather than bond markets? Because by saying bond markets, we exclude money market instruments, but when we say debt markets, we include both money markets and bond markets. Okay, so that brings us to the so we have divided capital markets into debt DCM and ECM. Okay, now we are going to take a look at DCM and further divide DCM into that's right, proper English. Classify into okay. Right. So further classification of DCM is bond markets and money markets. What is the distinction? Can someone tell me? How should I distinguish between bond markets and money markets? Like why I'm giving you some, we know we have looked at treasury bonds. I have encouraged you to look at this chart. This is the US 10-year treasury bond interest rate. Treasury note actually it's called, but it's a bond market instrument. So how much is the US treasury paying for to borrow for 10 years at this point of time? Well, in 1981, it was paying something like 15-16%. Okay, whereas today it is paying only 1.32%. A big difference. So you see how interest rates can move. Okay, what massive changes you can have in interest rates. So you should track all these things, what's happening, and because this is one of the most important markets in the world, the U.S. Treasury bond markets. You'll understand why when we get into the details of bond pricing. But let's have a little discussion here. Who can tell me what is the why did I divide this? Okay, so if I divide the class into boys and girls, okay, there must be some differences between boys and girls. So here, there's what are the differences between bonds and bond markets and money markets? Anybody wants to tell me? You already know some of the examples. You know that this kind of treasury bond, bond market instrument is part of the bond market. But then we talked about T-bills and commercial paper, which are part of the money market. So based on these, based on this information, can anyone tell me how do we distinguish between bond markets and money markets? Yes, anyone? What happened? Everyone's sleeping. Let's ask somebody in
Sir,
particular. Yes.
sir, we can say that bond market are for long term and money market are for short term.
Okay. Uh, that's a good point. Okay. So bond markets. Okay. So long term. Let's say we want to be more specific. Can anyone be more specific? So the general idea is correct. Can you develop that little further? Like you're saying, as if you're saying Sachin is tall. Now, can you develop it further? Then you say, well, Sachin is more than 6 feet tall. Something like that. So can you be more specific now? You're saying long term, short term. Your idea is correct, but can you be more specific? Yes? Anybody? You understand my question? Yes? What happened? Nobody, everybody's sleeping.
So debt securities whose maturity period is more than 1 year?
Correct, right? So that is the right thing. So maturity, but again, can you refine that further? Instead of maturity, can we say something? Okay, is okay. This is correct. Maturity is more than 1 year. Bond markets. Okay, so these are debt securities. Correctly answered. Okay, you're learning the lingo that I'm teaching you. Okay, so you will be disappointed when you go into industry because you will find that people are not using this kind of strict lingo because they'll just use. But you should understand conceptually what is the correct lingo. When you're learning, you should learn like that. Okay, so bond markets is debt securities with the word I'm looking for is initial maturity. Okay, why do you have to say initial maturity? Because you could have a 30-year bond or you could have a 10-year note which was issued 9.5 years ago. Okay, so when you look at that 10-year note today, the remaining maturity is only about 6 months. So technically, this is also less than maturity. So when when you say maturity, then it could be what is the usually what we mean by maturity is how many more months from today, right? So technically that maturity is less than 1 year, but we won't call it a money market instrument. We'll still call it a bond market instrument because the critical term is initial maturity. So that means when the security is issued, what was the maturity at that time? Okay, so the key word to remember. So this is an important point that this is the first one, the first point of difference. Okay, debt securities with initial maturity greater than 1 year. Okay, so obviously money markets is debt securities with initial maturity. We're writing it in a baby step way, but let's write it so that there is no problem in your when you study. Okay, so initial maturity, this has to be less than 1 year. Okay, right. So this is why you see when you look at treasury bills, if you look at the treasury bill market in any country, you will find that you will never get anything more than 365-day treasury bills. Okay, because treasury bills are a money market instrument, so the initial maturity has to be, 1 year or less actually. So we could actually say greater than 1 year for bonds, and this is less than equal to. But then we are forgetting, if I did not write the equal to here, then there would be a limbo status for exactly 365 days initial maturity instrument. That is, there's no limbo there actually. That should be part of the money market club, right? So this is the point. The first point is money market versus bond markets is debt securities with initial maturity less than equal to 1 year is money markets, greater than 1 year is debt markets. All right. Next, what is the other difference? Anybody else? There's a second point of difference. Yes, anybody? Okay, let's try to finish this. Let's ask Kirit, can you tell us what is the second point? Kirit is sleeping. Who else is sleeping? Okay, let's ask somebody who was. Okay, Shivangi, can you tell us any guess what is the second point of distinction? These are all basic things which I think. I mean, I don't know. I would have thought it would have already been covered in your first year, and when you're covering, markets in general. But anyway, Shivangi is also sleeping. Everybody is sleeping. Okay, who do we ask? Let's ask Vaibhav. Vaibhav is also sleeping. So everybody is sleeping. Who is not sleeping? Okay, let's ask Munjal. Yes, Piyush. Any answer? Can you hear me? I mean, I'm just concerned now that maybe I can't be heard. Can you hear me?
Yes, sir.
Yes, sir. You're
Okay,
audible.
so you can hear me. So, but all these people are sleeping. Nihar is also sleeping. All sleeping. Neha. Yes, Nihar is active now. Nihar, you want to say something?
No, sir. I only had this the first one in mind.
Acha, okay, fine. So second one you didn't, you are not clear what it should be. Okay, so fine. So then what we'll do is again, as you can see here, that when we go around asking people, we end up spending a lot of time. I wouldn't say it's a waste of time because it wakes people up, but generally that you can understand why a lecture tutorial mode is much more efficient for delivering learning. If the students are mature and attentive and ask questions whenever there is any confusion. Okay,
Sir, can we say about liquidity? Like bond markets are less liquid compared to money markets.
really, I wouldn't say that actually. I don't think you can say that actually, because that's a general statement. Because remember, if you make those kind of statements, those are you're not qualifying the statement in any way. So that becomes a general statement that applies all the time. But that's not true. It will not apply all the time. All right. So
So can it be the interest income?
it is related to the interest income. So this is what I'm writing. The second point that it's either so basically in order to be so the first point of difference is uh, that you have the first is the initial maturity. The 2 points to note is the initial maturity. The distinction is on the point of initial maturity, and the distinction is on the point of coupon. Okay, so therefore, okay, so to be a money market security. So is this point clear now? Now you remember this. So Isha was almost there actually. That the interest income. Yes, the interest income. The way you would say it is that to use the language that she was using to take it down that road itself. That what you would say is that in the case of bond markets, the interest income is explicit because it comes in the form of coupons. As you can see here, when you're analyzing a bond, it's paying periodic coupons. It's a 4-year bond. So in the fourth year, it pays the principal of 1,000 plus the 40 coupon. And here it pays every year, it pays annual coupons. So this is explicit payment of interest. Okay. So to take Isha's language, you would say the interest income is explicit in the case of bonds, but in the case of bills or money market in the case of bond market instruments, in the case of money market instruments, the interest income is implicit. Okay, so it is without coupons. So of course, please don't write without like this. Don't go and tell people in industry that our finance teacher told us to write without like this, because I'm only writing it like this because I want to kind of stick my finger in your face and point out to you that these things do not have coupons. So I'm writing it like this. But in real life, of course, you don't write it like this. Okay. So there are two important points of difference between bond market securities and money market securities. Both are part of debt markets or debt capital markets. Initial maturity is one and coupons is the other one. Okay, whether explicit coupons, or we can say another way to do it is to take the language that Isha has used, explicit interest. And in the case of money markets, it is, since it's going into the next line anyway, explicit interest income, and then we can say implicit interest income. Okay, so explicit, opposite of explicit is interest, explicit, implicit interest income. Okay, so this is the second point. Now, what do I mean by implicit? Now you have seen what is meant by explicit interest income, $40. This is the 4% coupon on the $1,000 par that is coming every year. Okay, now this is explicit payment of interest. Now, if you do, if you buy, let's go back to this where we had the discussion. Right now, this is, let's assume that this is a money market instrument. Okay, so it's a 90-day treasury bill. So I buy the 90-day treasury bill at 85, and the treasury bill is redeemed at face value at 100%. Okay, so this probably is a country like Argentina or somewhere like that, which would, there the interest rate would be even higher. In Argentina, the interest rates are crazy. So that would be something like this. I would make 42% or something like that for 6 months. Okay. So Argentine treasury bills, if I buy the treasury bill. Remember that they don't pay any coupon because it's a treasury bill. Okay, it's a money market instrument. So how do I get my interest? So this is what I mean by implicit interest income. So obviously, if I buy something at 70 and I get redeemed at 100, so there is a price difference there, right? So I get my, how do we write this? Okay, this is J15. Where is the J15 and all? Okay, so if we go here, right? Make this a little smaller. You can see everything, and we can see this a little. Right. All right. Okay. So the numerator is the exit price minus entry price, and the denominator, look over here, and the denominator is the entry price itself. That's my return over the period. So although it doesn't play an explicit coupon, I still get a return on it. Okay, which is completely in the form of price appreciation, but there is an implicit interest income there. That's what we call the interest income, the implicit interest income, which is the numerator by the denominator. Okay, and the numerator, you saw what it is. So this is an example where you don't get a coupon, but you still get some implicit interest income, which is shown over here. All right. So therefore, this is the important distinction between money markets and money market to be a bond market instrument. Okay. So to be a money market instrument, I'm just writing it. Okay, it is actually, it should be a debt security should satisfy both the conditions. So I'm just going to say to it. Okay, it should meet both conditions. Again, the English is not very good. Should meet both criteria. I'm just writing conditions. Okay, you understand what I mean? That if in order for something to be a money market instrument, it must be, first of all, issued with an initial maturity less than 1 year. Okay, less than equal to 1 year. This is condition number one. And condition number two, that there must not be any explicit interest coupon payment. Okay, it has to meet both the conditions, and only then will it be a money market instrument. Okay, if it's not a money market instrument, else it's a bond market instrument. Okay, so some basic stuff we are covering, but we want to make sure that the conceptions, the clarity is very good on these basics. Okay, so we have to be clear about these things. Okay, so to be a money market instrument, it should meet both conditions, else it's a bond market instrument. Okay, so this, for instance, I had gone. I remember once the reason I came up with this kind of definition. I had gone to one of these. I forget which one. It was one of these girls' colleges in Delhi, and this. So I was talking to them about financial markets, and then one girl asked this very important question. She said, "So when I discussed this as these are the two differences," and then she immediately said, "So then what about zero coupon bonds?" Okay, so that's why now I to give the definition like this. Okay, zero coupon bonds should be classified as on-market instruments from now. What is this process called stripping? We'll explain to you just now. Okay, I'll give you the link for this. Okay. I'll explain to you why I'm saying this. So we have to understand all these things. This is a question that she asked in that girl from that college. That's a very good question actually, because it attacks the definition right in the middle, in the heart of the definition. It creates a problem, and so we have to revise the definition. Okay, now let me explain what is. So zero coupon bonds should be classified as bond market instruments. Okay, why? Because they will not meet the condition required to become money market instruments. Therefore, as a residual rule, they will become bond market instruments. And what do you need to meet? What criteria do you need to meet in order to be classified as a money market instrument? Well, your initial maturity has to be greater than 1 year. And initial maturity has to be less than equal to 1 year, and it should not carry a coupon. Now, well, a zero coupon bond is basically a bond that does not pay any coupon. So this could be a zero coupon bond. But normally we don't use the term zero coupon bonds unless the initial maturity is greater than 1 year. Okay. So then what happens is, then this becomes the same 42.86. Maybe it's a 10-year security or a 5-year security. You issue it for 5 years like this, and you issue it with a discount. These are very rare actually. For original issue zero coupon bonds are very rare in the debt markets. They're normally generated by the stripping process, which I'll explain just now. Then, so in that case, but then the problem is that it would not become a money market instrument because the initial maturity is it's not meeting the condition of less than equal to 1 year, and therefore it can't be a money market instrument. It will be a bond market instrument. So the sentence structure is a little bit complex. You should understand what it is. Let me put a little star here so that you can understand. You can split up the sentence. They should be classified as one of the on the rare occasions that they are generated other than by stripping. Okay, the stripping process I'll explain what it is. Okay, that means this means generated other than by stripping means a company comes directly and say Airtel does a 5-year zero coupon bond for $1 billion, which means Airtel issues a bond for 5 years. They don't pay any coupon for 5 years, and at the end of 5 years they'll pay something like this. Okay, so they'll pay back 100. And maybe they issue the bond at maybe 85. All right. So Airtel has to borrow at nearly 18% for 5 years. So Airtel issues a 5-year bond, a zero coupon bond at 85. 85% of face value, and then after 5 years they redeem it 100% of face value. So the investor gets a return of nearly 18%. Now this kind of issue is very rare in the international capital markets. It's very, very rare. Okay. Normally, you don't get zero coupon bonds issued like this. Extremely rare. So that's why I've said that on the rare occasion that they're generated other than by stripping. So here in this kind of a thing where Airtel straight away issues a zero coupon bond in the international bond markets, that's a very rare phenomenon. Okay. So normally zero coupon bond, but if it happens that way, then there would always be an initial maturity greater than 1 year. Okay. So therefore, it would not be a money market instrument. It would be a bond market instrument. Okay, now let us understand what is meant by stripping here. Again, giving a little. Okay, so this actually becomes, this word comes from the word strips. What are strips? Let's just load up the. Just give me a second. Okay. Yeah, let me just. Yeah, let me just show you. Very important learning. Okay, you're going to be finance professionals. You must have a very good understanding. Usually, a lot of finance teaching focuses mostly on equity securities. This is a US Treasury page, strips. Okay, you can read what it is. I'll blow it up a little bit. So I'm not going to write it here. What I'm going to do is I'm just going to copy this and give it to you here. Okay, strips. Okay, let me just do it here. To read this, okay, and learn it yourself. Separate treatment of registered. Let's see here what it is. Yeah, registered interest and principal of securities. Okay, so separate trading. So what you're doing is you're basically, the reason it's called strip is you strip it. It matches the nicely, acronym is also matching. But by stripping, we normally mean that we strip the coupons. What we do is, see, normally this is a debt security which is issued by the US Treasury, and the same person who's holding the debt security, the guy holds on to it. Every year he gets the coupons, and then at the end of 4 years he gets the coupon and the principal. Now what you do is you strip all these separate coupon payments. You strip out these the first year coupon, you strip out the second year coupon, you strip out the third year coupon, fourth year coupon, and you strip out the principal separately. Now you strip out all the component cash flows of this bond. You strip them out from the the holistic concept of the bond, and you start trading them separately. That's what they mean here. Separate trading, very simple definition. Separate trading. Separate trading of what? The registered interest and principal. Yeah, obviously this is the registered interest and principal. Okay, of securities. Okay, so you can see what is meant by strips. Okay, so this is a very important thing because it has serious implications for derivative pricing, because in pricing different derivative products and other kinds of products as well, we generally prefer zero coupon securities. Why? Because we don't have, in the case of zero coupon securities, this is a very important thing to understand, which is connected to the point we discussed with respect to YTM. You know that YTM has a reinvestment risk embedded in it, because you cannot realize the YTM unless the third assumption hold, that is, the interim coupons are reinvested at the YTM. So here, for instance, in the case of a YTM, if you look at a bond with a YTM of, and let's look at this one. Okay, the YTM is 5% for this bond. Now, technically, if you hold this bond, people tend to think that they'll realize 5%, but that's only true if you can reinvest all the interim coupons for 5% at 5%. Otherwise, you're not going to realize 5% by holding this bond, by buying it at this price. Okay, 964 for $1,000 face value bond. By buying it here, you can't realize 5% at the end unless you can reinvest all the interim coupons at. But now, here's the interesting thing about why do we love zero coupon bonds in debt markets? Why do we love zero coupon bonds? Because, yeah. Okay, so by definition, because there is no coupon being paid, there are the interim coupons statement. Behind all this, okay? Interim pre-maturity coupon. Okay, understand this point. Zero coupon bonds by definition do not have reinvestment risk, because if I buy a zero coupon bond issued by Airtel for 5 years at 85, unless Airtel defaults, I don't have any coupon reinvestment risk to worry about, because in between now and 5 years, there's no interim coupon being paid. So if Airtel doesn't default and I hold the bond to maturity, in the case of a zero coupon bond, I am guaranteed to receive this nominal yield. Okay, I'm guaranteed to receive this nominal yield because there is there's nothing in between the initial purchase and the final maturity. Very important point. So this is why we love zero coupon bonds in debt markets, because they do not carry interest reinvestment risk, and so we can accurately estimate the return on those securities. Okay, so let's understand the why do we love this? The implication of not having reinvestment risk. We can accurately, okay, assuming, again, everything has to be clarified. Okay, we can't really estimate it. I needed to make that assumption that Airtel will not default, so we have to assume no credit risk. We can accurately estimate the nominal return from holding that. I'll just write bond here, okay, just a short word, to maturity. Are you following this? Okay. Why do we love zero coupon bonds? Zero coupon bonds don't have reinvestment risk. What is the implication of that? The implication of that, we can accurately estimate the nominal return. Okay, this is the important point. We can accurately estimate the nominal return, which is basically related to the same. Once you understand the implication of reinvestment risk for coupon-bearing securities and using the YTM to estimate the nominal return, well, that estimate is only going to be correct if you can invest all the interim coupons at the YTM rate, which there's no guarantee of. But in the case of zero coupon bonds, you don't have to worry about that, because if there's no credit risk, then you can estimate the nominal return from holding the bond to maturity accurately. Okay, so just to recap, what are we covering? Okay, we started with the discussion. We're continuing with the discussions of YTM. Wanted to talk about the term structure of interest rates, the new term expression that you learned. Yield curve, also called a term structure of interest rates. That's the first thing you learned. Then we said that term structure is a general expression. It can be used even for implied volatilities, okay, of options, something like this. Okay, this also is called a term structure of interest rates. All right. So it's their volatility term structure. Then we talked about the importance of your studying the Treasurer's Handbook, reading it from top to bottom, and corporate credit ratings, and understanding the credit rating, the letter codes. No need to memorize, but understand what it means broadly. Then now we started talking about the classifications of different parts of the the financial market universe. Okay. So we can actually make this even better. The capital markets are a part of financial markets globe. The broader term is financial markets. Within that, you have capital markets, which are basically concerned with debt and equity securities. So the division of capital markets into DCM and ECM. Then we started focusing on, and hybrids go into one of the two departments. Then we started focusing on debt capital markets, and we talked about dividing debt capital markets into bond markets and money markets. What is the distinction? Initial maturity is 1 point and coupons. So the way we decide the classification is that first we see whether it's going to be a money market instrument or not. If it is going to be a money market instrument, it has to meet both the criteria. So it has to have initial maturity less than or equal to 1 year, or coupon, it should not have any explicit coupon. If it can't satisfy those two conditions, then it's going to be a bond market instrument. Okay, so therefore zero coupon bonds will be a bond market instruments, because either they arise from stripping by taking out something from an original bond market security, or they will typically come as a primary issue which will have a initial maturity greater than 1 year. So they can't become money market securities. Okay, they will be bond market securities. Zero coupon bonds, and zero coupon bonds are, we love them in debt markets because they do not carry reinvestment risk. Okay, I'm not going to highlight the very important point. They do not carry reinvestment risk, so we can accurately estimate the return, and this has important implications for the pricing of the fair value calculations for derivatives and things like that, because you get certainty. Okay, that's the important thing. Whereas in YTM, for a typical conventional bond, you don't have certainty. Like this one, you're paying this much for this bond that's going to redeem at $1,000, but you still can't be sure that you're going to realize 3% unless you can actually reinvest all these coupons at 3%. So you don't really have any clarity, strictly speaking. So that's why we love zero coupon bonds. Okay, so right. Then we also understood what is meant by stripping. So most of the zero coupon bonds we see in the debt markets, trading in the debt markets, they are actually generated by stripping, by taking an original issue bond market security, which is more than 1 year initial maturity, and then we strip out all these interim coupons and we strip out the principal and we trade them separately. That's why the US Treasury says separate trading of registered interest and principal of securities. So we trade this coupon separately as a zero coupon bond. We trade this coupon as another different zero coupon bond, and so on and so forth. Okay, so this you read on your own to get the idea. So I'm not going to go into the details of that. So this is stripping, and these are called treasury strips. All right, so this is basically the classification of capital markets into debt cap, DCM and ECM, and then DCM itself is divided into bond markets and money markets. So you understand the differences between the two. Then we'll learn about zero coupon bonds and stripping as well. Okay. Now I want to highlight one more point. Okay, quickly. I'm not going to ask questions because we don't have much time left. I want to highlight one more point to you, because so many of you are sleeping in the class that I'm not sure you're picking up on these points. This photograph, look at this photograph that has been given here. Okay. So understand the relationship between, just going back to YTM again. Okay, going back to YTM again. The relationship between the market price. Okay. So let's look at this. YTM. Another important point to learn, because these are very basic concepts, but since so many basic concepts are not clear, I don't want to take a chance on this also. I'm going to make sure that you understand this point. These are all fundamentals of finance, in particular about debt securities. Okay, what are we talking about? This topic is the relationship between the YTM, which is, remember, the YTM is always a market interest rate. Okay? So when we look at this, we say, I ask you, what is the YTM on a 10-year US Treasury note right now? You look up a chart or a bond yield pricing sheet, and you give me the market price. It's 1.321%. Last night's closing in the US. Okay, so the US Treasury YTM for 10 years is 1.32%. That's what you say. Okay, so YTM, that's a market interest rate. YTM is a market interest rate. The bond coupon is not a market interest rate. Look at this bond. The bond coupon is 4%. Principal is $1,000. So we are seeing par value for this bond is $1,000. Then we have, so these are all different concepts. Be very, very clear about go through these lectures once again. Make sure you understand. I'm highlighting all the important points in bold. You must understand these basics inside out. Okay. Coupon. I'm not highlighting the bond. Okay. YTM is different from the coupon. Here the YTM is 5%. The coupon is 4% on this bond. The market price is 964.54, and the par value is 1,000. Okay, because this is showing both the coupon, the final coupon, and the par value together. The redemption of principal and final coupon are lumped together, so it's actually 1,000 plus 40. So market prices. Coupon. So there are four different concepts. YTM, which is the market interest rates, here is 5%. Coupon, the market price of the bond, and the par value of the bond. So notice one thing here, everything is given in this sheet, but in this picture, but understand it. when the YTM is greater than the coupon as a percentage of par value. Here, coupon is 4%. This doesn't change. Once you lock into a bond, the coupon will not change. So coupon as percentage of par is 4%. The YTM is 5%. When this is the case, YTM, compare it to the coupon as percentage of par. YTM is greater than coupon as percentage of par, which means that the market price of the bond is going to be below the par value of the bond. Par value is 1,964 is the market price. When the YTM is less than the coupon as percentage of par, then the market price of the bond is greater than the par value of the bond. Okay, here, make sure you understand these concepts. You should be able to do it blindfolded. This kind of stuff you should be able to do blindfolded. Whatever we have covered today, again, lecture mode, we have most of the people were sleeping, but please make sure, that's why the recording is shared with you. Make sure you go back and revise all these concepts so that until you can do these things blindfolded with your hands tied behind your back. Okay, make sure these are all very important fundamental concepts we have covered today. Okay, we may not have spent any time on the book, but that doesn't matter because you need to be clear about these fundamentals. So please make sure you understand these inside out. Okay, that is your responsibility. Okay, so then our class is dismissed now. I haven't taken too much time today. Then too much extra time. Please remember you have a quiz coming up tomorrow. Okay, please be alert. Don't sleep before the quiz. 8:30 p.m. Sunday, 5 September tomorrow. 20% quiz. Okay, approximately. So I'll probably give you 22 minutes. There are 20 questions, so I'll give you like 22 minutes. This is a lot of time actually. A lot of time. So please be ready at this point. I'll paste it in the Teams feed. I'll paste the link in the Teams feed. Please be ready and don't wait till the last minute. So if it's 8:30 means the submission time is going to be 8:52. So don't try to submit at 8:52 because then the door is already closed. Submit at 8:51.3 or something like that. Okay. So yeah, please be sure about that. Okay, because if you, I can't have another quiz on this. All right. So the class is dismissed. Now those who have questions can stay back, and the rest of you can go. Anybody? Any questions? Yes? No? No questions? I hope some people are awake. Let's ask somebody who's awake.
Yes.
Who is awake? You're awake? Good. Okay.
Yes, sir.
Okay, good. So at least 3 people are awake. Okay, good. All right. So I'll stop the recording then. And so please remember the quiz coming up tomorrow evening. And please remember what I said about the potential change in the class. So either September 11th at night there'll be a class, or that other date which is there in the email. I hopefully will remember to forward it to you. Okay. So stop recording.